we're here with Simon to talk about the new exposure draft, revenue from contracts with customers. Simon, you and I have been looking at this exposure draft for some time now, back from its first iterations in 2010. We've now got the new exposure draft issued in 2011, and a lot has changed since then. But what do you think are the key practical considerations that our technology clients will be thinking about?
Well, I think it depends a bit where you start from. I certainly think that software companies are going to have a harder time with the standard than hardware and services or cloud companies. There's more changes for them. And also, you've got the difference between the US GAAP companies who've been used to following strict rules and the IFRS guys who will be starting from different points depending on their accounting policy choices. But what's true is all of them have got something to look for in this standard, and all of them will need to think carefully about how they take their accounting forward.
Okay, so if we look through some of the steps within the proposed model, there's 5 steps. The first one is identifying the contract with the customer. Well, I guess my thoughts on this is that the guidance in terms of combining contracts is probably similar for US reporters, certainly. So I'm not quite sure whether there is a difference, but it's the level of evidence of arrangement. That's the area I think maybe there's some differences.
Yeah, I picked up a subtle difference here in that the contract, the ED talks about a legally enforceable contract as being the benchmark for revenue recognition. And I think for US GAAP reporters, they may find that's a slightly lower threshold than they're used to, where they've been applying evidence of arrangement, which sometimes can be in advance of the legal enforceable arrangement. So perhaps in the past they'd have made sure they got a PO and a contract, when in actual fact they have a legally enforceable arrangement just with the PO.
Yeah, and that's because their customary practice is always to get a contract, so just having the purchase order wouldn't be enough in those cases.
That's right, yeah.
What about the second step? I guess, when we're talking about identifying the individual performance obligations in the contracts, again, I think there is some guidance there which is not dissimilar in terms of what the elements of a contract are within US GAAP and thinking about the performance obligations. So I'm not sure I see a particular difference on the bundling of those elements together, but I see one of the biggest changes in relation to unspecified upgrade rights and how those are going to be accounted for under the new ED.
Yeah, I mean, that's certainly a change. I mean, US GAAP reporters have been used to the fact that if they've got unspecified upgrade rights, that means they apply subscription accounting and recognise the licence revenue ratably over the term of the arrangement. That's a specific change. However, I think that companies will more generally need to just look more closely at what they've got in their contracts. And some IFRS reporters won't have been so used to scanning their contracts, picking out each of the individual obligations and realising that each of those obligations may have a different revenue profile. So there could be some more care and diligence over how contracts are written and how they're read by accounting teams. I mean, the one thing, of course, we haven't mentioned, of course, is that for US GAAP reporters, this whole identification of elements is a very stressful thing currently, because they're worried that an element they find, they may not have evidence of fair value under the strict rules. Under the new ED, that worry goes away, because, as we'll talk about later, you'll always be able to get fair value. So those companies will be freer in terms of finding these elements and then accounting for them.
And thinking about the different performance obligations you can identify in those contracts, one of the areas is options and additional elements within a contract. So an option to extend the life of a licence or options for additional services and goods.
That's right. I mean, and that's an area where US GAAP has some very prescriptive guidance, particularly for software companies. And the new ED also includes some reasonably complex guidance. And there's a subtle change there, and I think this will force technology companies to look closely at their pricing policies, in that the new ED takes much more of a market approach to assessing whether a discount is significant or not, rather than a customer-specific approach. And therefore, you'll see the need to reword and reframe some discount clauses for companies going forward.
Yeah, there's a lot of guidance under US GAAP on whether an option is significant and incremental, and the new guidance is different, talking about material rights and for similar items.
Yeah. So there's a judgment there, but there's also some complexity.
So let's turn to the third step in the model, determining the transaction price. So I suppose, again, here, a lot of the rules are similar, but there's one big change that I see, which is collectability. I mean, that's not there in the exposure draft, and of course we're very familiar with that, particularly under US GAAP, where you have to make sure that collectability is reasonably assured before you take your revenue. Yeah,
this is a change for companies, in that the ED is currently drafted, sidesteps collectability and says you just work out whether the revenue can be recognised. And then you consider collectability separately account for that, and then recognise the associated expense on a separate line item in the income statement.
Yeah, adjacent to revenue, isn't it?
Adjacent, yeah, and so you sort of say, here's our good revenue and here's what we think we're not going to collect. That's the proposal. I know there's some recent debate around whether they'll carry that forward to the final standard, so we'll just have to watch to see what happens on that. The one thing they have actually firmed up on is the consideration around time value for money, whether you discount revenue. They've now settled on the idea that you will only need to do that if there's a significant period between performance and collecting cash, and they've identified that period as being 1 year, which is fairly consistent with current US GAAP, and I think in broad terms will probably mean most IFRS reporters also won't end up discounting their revenue.
So a lot of companies will find that quite a useful, practical guidance on when they have to apply that time value of money.
Yeah.
Okay. And the fourth step, which is once you've identified your transaction price, allocating that to the individual performance obligations. Now, we've talked already about the idea, firstly, that we don't have this hurdle of VSOE. So that's the biggest change, I guess, for software companies, thinking about having to defer revenue just because they don't have VSOE for a particular element. So that's all gone.
Yeah, and you and I, Phil, we've had many times when we've seen situations where companies have deferred large amounts of revenue simply because they did not have this VSOE of fair value for a very small element to be delivered in the future. Yeah. That all goes, and I think my view is that opens up some wider commercial possibilities for technology companies who've been reporting under US GAAP. I mean, we've had a flavour of that because the hardware companies have recently had some relief from that under US GAAP, but that's now going to be across the board and will free up sales teams to offer additional products, not having to worry about the fact that that may cause difficult revenue recognition.
Yeah, they'll no longer be having to consult, before they're offering anything to their customers and going to their accounting departments first. They'll be able to give a broader range of services.
Yeah. So I think that's a real key change, particularly for US GAAP reporters.
And of course, they are going to allow the residual method as well for calculating.
That's in there, so that's useful. That gets around the complexity of working out what the fair value is of a licence, say, that's never sold separately. So it's good to see that there as well. Yeah,
still an area where the boards are still discussing this, and so I guess the final positions could change.
And they've got the caveat that you can only use the residual method when the fees are highly variable. That's not been defined, and there could be some additional guidance on that.
Okay, well, let's turn to the fifth section, which is on when to recognise the revenue. When you've identified your performance measures and you're trying to spread the revenue over that in relation to the performance measures. I guess, again, here, there may not be a change. Certainly for US reporters, they'll be used to the idea of identifying the inputs and output measures and spreading revenue based on that. So I'm not sure there's a difference in general, but one area, again, time-based licenses still to be finalised. But at the moment, the guidance in the exposure draft suggests that time-based licenses would be recognised up front.
Yeah, and which will be a change for a lot of US GAAP reporters and some IFRS reporters. And really the boards just need to reach a final conclusion on this one and then everyone sort of fall in line. But I think there's likely to be change for a lot of companies in this area.
Yeah, and there's a bit of debate in the boards at the moment between the FASB and IASB between which ones should, whether you should be going on a time-based licence, recognising it over a period of time.
That's right, but I mean the practical commercial impact would be that if there's a clear rule that these licences are recognisable up front, that brings them back into the kit bag of sales teams who previously have had to deal with the fact they'd be recognised ratably.
Yep. And I guess one area which people will welcome is the changes in the exposure draft and later deliberations to assess onerous contracts at a contract level rather than at an individual performance level. I mean, that makes sense to me. It seems they've decided they're going to keep the existing guidance where you'd look at whether the whole contract as a whole is loss-making rather than one particular performance obligation.
Yeah, I think that's right, although I've not spent much time looking at that because I don't know about you, Phil, but I don't have many loss-making contracts with my clients.
And I guess thinking about the transition requirements, the exposure draft has given some additional reliefs there. So, of course, this is going to be applied retrospectively. And I think a lot of people had concerns about that, particularly for longer contracts. And they have given some reliefs for contracts that are beginning and ending within the year and are finished before the transition date or the application of the new standard.
Yeah, that's right. I mean, transitions are always a difficult area. There's always some work to be done looking at historical contracts. But I guess my sense is practically companies should not ignore the fact that this could have implications and create opportunities commercially as well to do different things in terms of the commercial proposition. They shouldn't overlook that as they think about transition as well.
Yep, so a lot for all our companies and all our clients to think about.
Yeah, every technology company is going to have to look at this, and they'll see some impacts along the way.
Thank you, Simon.